It's interesting. If anything, we're seeing accelerating bond ETF flows. We're up 40% relative to this time last year. So
in fund flows coming in?
Fund flows. Wow. So that's the industry. For us personally, it's like 30-odd%, but it's the fastest the industry's ever crossed 100 billion. 40% relative to last year.
Good question.
Why?
Yeah.
Why?
I mean, everybody continues to see the opportunity in income. So to sort of break this down a little bit, you are seeing a relative, I think, quality play. Mm-hmm. So again, just like last year, our largest flows so far are in SGov, our 0 to 3 month T-bill fund. That's like 10 billion. It's approaching 80 billion in assets, but that's 10 billion so far this year. Treasuries in general represent about half our flows this year. And then you have multi-sector and investment grade following.
At SGov, what do you guys buy? Short term, midterm, the whole curve? What do you guys?
Nope, just 0 to 3 month T-bills.
Wow.
That's it.
And a 3 month T-bill is $369.
Yeah. So
to you guys, Sweeney and Laipply, is that like a decent coupon? Do you feel that's rich?
I think the way people are looking at it is that, relative to locking up your money in a bank deposit or what have you, it's just a good place to watch how things play out, and then you can move on from there. That seems to be what's happening. We're seeing that. We're seeing people allocate to defined maturity as well.
Right. I just want to point out, folks, I use the BTMM screen there because Mr. Secunda taught me how to use that.
Oh, okay.
That's why. It's like the Laipply fixed income. It's Ian Lingen over at BMO uses it. It's like permanent. Yeah.
Do your investors, are they going to pay attention to what the Fed does today? Or do you feel like they're just looking for some safety here in the near term?
They're going to pay attention. I think the real question, obviously, is how is this going to impact inflation? Break evens on 2-year up to 3.25. A very, very sharp move over the last few weeks, as we know. Some people are looking at that as actually an opportunity on the front end. So we've seen interest. For example, we have a 0 to 1 year TIPS fund, ICPI. We just started seeing flows into that. So that's telling you that people are looking at those wide break evens maybe as an opportunity. Maybe they've run quite a bit. So we're starting to see some of that happening.
In my municipal bond portfolio, I've been doing a laddered approach of maturity. Do you see that in just regular corporate credit kind of thing?
We do. That's one of our more pronounced flows. So we have defined maturity ETFs called I-bonds. So they're about 40 billion in the U.S., over 50 globally. They're seeing a lot of flows right now. Why? Because that's a great way to see through the volatility, lock in yields, ladder, and just sort of ride through it. And
here's the difference. Sweeney has laddered bonds. I have laddered tuition. That's laddered tuition. It's just a fabulous thing. With us from BlackRock, Steve Laipply, really with his hands. You look at, folks, you read what we're doing at Bloomberg and Balchunas and that, or you look at Barron's and all. He has a pulse of the flows. What's the marketing thing right now that you're nervous about? What's the in thing right now in ETFs where you go, maybe not?
Oh, I don't have that personally. I'm a bond guy. I'm boring, Tom, as you know. Very, very
I know. It's
boring.
amazing. What in the equity space where you're like, or private credit, you're like,
I don't have moments, but I think there's a lot of opportunity. The equity stuff where we're seeing a lot of interest, it makes sense, right? So you're seeing interest in the buffered products, things that are bond-like. That's where you're starting to see people sort of trading off. What does my downside protection look like? So I get asked the question often: do I do bonds or buffered? And I think it's a combination of both. It just depends on what your comfort level is, asset allocation wise.
Steve, Tom, make sure that we continue to focus on all the new issuance coming out of these big tech companies. What do you guys make of that? Because I'm sure, BlackRock, you're the first phone call that Morgan Stanley or Goldman Sachs makes. How do you guys think about that?
It's incredible. The issuance levels this year, I think, are on pace for potentially a record. So it's been an amazing. It's been an amazing amount of issuance. I think so far it's been pretty well tolerated. Even in treasuries, people talk often about the back end of the curve. Auctions have been going pretty well. So I think, again, the demand seems to be holding in there for fixed income overall.
Yeah. What do you expect to hear? What would you like to hear from your Federal Reserve Chair today?
Yeah, great question. So I think they're obviously going to acknowledge the backdrop of energy prices. I think they're going to, what do they do with the dots? I don't know. The market obviously pushed the cut out all the way to the end of the year. it'll be interesting to see how they address this, whether they think it's going to be more of a demand shock or whether they think it has the potential to feed in to longer term worry. I would say longer term break evens seem to be not moving too much. If you look at one of their gauges, five-year inflation, it's actually lower the last several weeks. So that's interesting as well.
I look at the ETF miracle that's there. I've never asked this question. What inning are we in from the transfer from open-end investment companies, mutual funds and their flavors, over to ETFs? Where are we in that baseball game?
I think we're early. I do think long-term there's still going to be demand for the traditional mutual fund product for defined contribution, et cetera. But I think we're pretty early. I mean, I think in bonds in particular, we're still like 3% of a $100-odd trillion market. So very early still, despite all these flows.
What's just real quickly, what's the area that you're seeing the most flow right now? I don't know, maybe the last few weeks with all this war issues that the markets had to deal with. Have you seen more flow into your short-term stuff easier? I mean,
yeah, that's the ESCO flow. I mean, I think treasuries so far, again, are our largest flow, followed by sort of broad multi-sector, think ag as an example, and then investment grade. So, that quality trend seems to be intact. Treasuries, yeah, ESCO is a big part of it, but you've also seen allocations further out the curve. Second largest flow is GOVT, which is the entire treasury curve.